Hey guys, so it's your friendly neighborhood advisor here, Alexander Quinn, and today I'm going to be covering why you shouldn't care if the stock market crashes. First, I'm going to go into a little bit about explaining basically what it is and then why it happens. Then I'm going to give you 3 tips on basically why you just should not care if the stock market crashes. First off, what is a stock market crash? A stock market crash is just a quick, sudden drop in the average stock price, usually across the board. In general, the whole market for the most part is just bad, prices are low. Why does this happen? This usually happens from panic because it's not usually that the companies all of a sudden are all doing horribly. It's usually some type of news. If you look historically at when crashes tend to happen, most of the time, not every time, but most of the time, it is just because some bad news came on, or everyone thought that we were going to war, or this, etc., and people thought that there was money to be gained or lost from a particular activity. A bit silly, in my opinion, and we're going to go into that quite a bit. Mass panic leads to everybody selling and nobody really buying. When you have everyone selling and nobody buying, then everyone who wants some gets it pretty easily from the sellers, and then nobody wants it anymore, and now you still have a bunch of people trying to sell it. It is not worth a whole lot. The only people coming in to scoop it up are those that see an opportunity, an advantage of some kind, or just don't know what's going on or aren't in tune with the news. During COVID, an example of basically why I say that it's due to emotional panic and not from an actual event is because during that time, companies, the top traded companies actually boomed. They did excellent. Facebook, Google, everyone, Tesla, they were reaching all-time highs. They were, I believe some of them were double or in triple. They were doing phenomenal, and everyone was trying to sell at first until stimulus checks came in, and then everyone wanted to invest. But yeah, so that's an example of where everyone sold because they thought, hey, bad things are coming, and instead they should have been buying. It was a great opportunity to get in there and just make tons of money. So let's get into the tips here. Tip number 1, you only lose money if you sell. The value of those companies hasn't actually declined. My example about COVID is just a perfect example of this. The stock value is not based on the intrinsic value of the companies. That means it's not based on the company's actual value. It's based on how people think it's going to do. But if everyone's selling off in a panic because of something that's usually unrelated to the company, then that especially shows that that company's value will still be there. And when do we actually see the companies lose value? Even when they do, they usually bounce back. It doesn't make a whole lot of sense to just sell out because there's a market crash. So the value hasn't changed. Tip number 2 is that a stock market crash is kind of like a clearance sale for a bunch of stuff that's not going to go out of style. It's like a clearance sale on a type of money. Instead of having dollars and seeing how inflation goes, you have stocks or crypto or bonds, whatever you have. But stocks are kind of another form of that. And it's a clearance sale on a form of currency, basically. So whatever companies you wanted to invest in for however long, you actually finally get to do it for super cheap. And when the dip is done, it's going to come back and you're going to have an instant rise just from that. You're just going to have plenty of money from that. Also, if you look at any 10-year time period, I can't think of a 10-year time period where people did not have more money after that 10-year time period. So even if you bought at the worst time and sold at the worst time, as long as you waited 10 years, then you're still going to be up. When the going is good, it's a crash, you're buying low, selling high, that's a phrase that most of you have probably heard already, then you're going to be doing exceptionally well because when the market rebounds, you will be right there on top with plenty of money. So yeah, it's a clearance sale basically because if there's not anything actually happening with, let's say, Google, Apple, Tesla, etc., then nothing's changed. Their value has not changed. It's just everyone is giving away dollars for a different thing, for an alternative. And during the Great Depression, they were burning money to stay warm because the value of the dollar was not worth anything. At that point, it's worth more to burn than to actually use as a dollar. And in this case, the value of the company has not changed. It's just the actual thing that you're holding. So I would get as much as you can of that. A bonus tip here, the whole buy low, sell high. If you haven't heard that already, people say buy low, sell high because the only way you can make a lot of money in stocks, now I'm not recommending this to be your main strategy. You should actually just pick solid companies and just invest in them long term. But typically how people make a lot of money in stocks, like a lot more than average, is they buy when it's low and they sell when it's high. And that's just the most common advice that you get across the board, other than being sure about the company that you're investing in and diversifying your portfolio. Tip number 3 is that crashes happen all the time and rebound to new highs. It's a regular part of the market. It's happened, depending on your definition of a crash, about 5 times in the last 100 years. It happens about every 20 years. The idea is that markets just in general, they go up and down. That is normal. Even when there's not a crash exactly, they always still go generally up and down. So you should just, this is a normal thing. And if you're going to freak out when it's low, then you should probably also freak out when it's high and then buy in. But that's kind of strange because when it's up, it usually also comes back down. So you're buying when it's high. If you buy when it's high and sell when it's low, you would always be losing money. So it just makes sense that if it's low, you should probably smartly consult a financial advisor and then consider buying in, because that is how you make bigger money. If you actually are looking at investing in stocks, I recommend that you consider long-term investments. Just kind of pick some companies or portfolios that you want to do long-term and stick with and not try to play the market. But as for the topic of this conversation, just kind of getting you to understand stock market crashes in general and why you shouldn't really care, that's why you shouldn't care. The point is, with the stock markets, just crashes, it's a normal thing. Ups and downs are pretty normal, it's pretty typical. And I guess an extra bonus tip here, if you are going to look into stock markets, then I guess I'll give you a quick rundown of that. If you decide you want to invest in stocks, then typically there's 2 main ways to go about it. There's a bit more, but basically there's what I refer to as stock investing and what I refer to as day trading. And stock investing is long-term. Day trading is basically you trade daily, typically. Stock investing, usually you keep it in for about a year, because after a year, the taxes go down drastically and you get immediate benefits from that. So if you're going to have it in long-term, you even just like 6 months, you might as well just wait out the rest of the year to reap those benefits. So for investing, you want to make sure you're certain of the companies that you're going into, or just get a portfolio, which is just a group of funds. Also diversify your assets so that if one company goes down, you don't go down, you are just kind of playing the field. And avoid certain sectors as well. You can go into a sector such as electricity, utilities, or tech, or whatever. But if you go into a particular area, then just try to have a little bit more diversity than that, or try to have some real estate on the side that you do, something like that. I think that you should diversify your assets a bit and try not to put all your eggs in one basket, because you really only get one life. And I personally don't think it's worth putting all your eggs in one basket. Those are my tips. If you're going to do day trading, then I recommend looking up a bunch of videos. Don't trust anyone out there and what they say. Trade paper stocks first, see if you're good at it before you go into it. If you're going to do regular investing, actually look into the greats that do it, the ones that do it the best, and learn from them and their strategies, like Warren Buffett. I hope these tips help someone out there. You all take care and have a wonderful day.